Price hikes seem to be impacting nearly every aspect of our lives.
Food inflation has slowed, but prices are still going up.
Inflation has raised costs for most everyday items at the grocery store.
But it's getting real unaffordable out here, and I have no idea what to do about it.
I can't be here anymore. I can't breathe here. I am sitting here, though, worried because I've got 2 other kids who are in college here.
It's just not affordable anymore. Houses, cars, groceries, like everything is so expensive. And it doesn't seem to be going down. And like car prices keep going up, home prices keep going up, and yet people are still making the same amount of money.
Something feels wrong in America, and people can sense it before anyone officially admits it. The paychecks still come, but they vanish faster. The stores are open, but the prices feel unreal. The stock market still flashes green, but underneath it, debt is cracking. Banks are bleeding quietly, and families are choosing which bill survives the month. This does not feel like a normal recession warning anymore. It feels deeper. Like the country is not just heading toward a financial crisis, but toward a moment where the entire system asks ordinary people to pay for everything it refused to fix. That strange feeling in the country does not begin in the stock market. It begins much closer to home. Inside checking accounts that empty too quickly, credit cards that never return to zero, and monthly budgets that no longer survive contact with reality. For years, the American consumer was treated like an unstoppable machine. If prices went up, people charged it. If wages fell behind, people financed the gap. If an emergency hit, they opened another account, delayed another payment, or stretched one more paycheck across rent, food, utilities, insurance, gas, and debt. But that machine is no longer accelerating. It is choking. Roughly 111 million Americans are now carrying credit card balances month after month. That is not convenience spending. That is survival spending wearing a plastic disguise. More than 27 million people are reportedly making only minimum payments, which means millions are not really paying down debt. They are renting time from banks at interest rates often near 20%. At that level, a $5,000 balance does not feel like $5,000 anymore. It becomes a trap that grows quietly in the background, while groceries, car insurance, rent, and electricity keep climbing in the foreground. And this is where the crisis becomes furious, because people are still being told to live within their means, while the means keep getting rewritten. A household budget that worked 2 years ago can collapse today without a single reckless purchase. A $300 grocery run becomes $430. A $120 utility bill becomes $190. A car payment that once seemed painful now sits beside insurance premiums that feel almost punitive. The problem is not just overspending. The problem is that the cost of basic participation in American life has moved faster than income. So people start choosing. Rent over credit cards, food over medical bills, electricity over student loans, gas to get to work over everything else. That is not financial irresponsibility. That is economic suffocation. And once survival math becomes normal, the next stage is no longer anxiety. It is failure, not because people suddenly forgot how to manage money, but because the gap between what they owe and what they earn has become too wide to cross. Bankruptcy is where the private struggle becomes a public record. It is the moment when delayed bills, minimum payments, late fees, medical balances, business loans, and exhausted savings finally turn into a legal surrender. And that surrender is spreading. In 2025, bankruptcy filings climbed to roughly 565,759 cases, an increase of about 11% from the year before. That alone would be alarming, but the more dangerous signal is that the trend is not slowing. Early 2026 filings were still rising at double-digit speed, with individual bankruptcy filings in February jumping to more than 43,000, compared with about 38,000 a year earlier. That is not a random bump. That is pressure becoming measurable. And it is not just households. Businesses are cracking too. Commercial bankruptcies have been rising, with some reports showing business filings up around 21% year over year. Restructurings, the kind used by larger companies trying to survive without fully collapsing, surged sharply. Small business bankruptcy filings are even more disturbing, because when small firms break, The damage spreads through jobs, landlords, suppliers, local banks, and entire communities. This is the part people miss. Bankruptcy is not the beginning of the crisis. It is the receipt. It shows that the pain already happened. The missed payments already piled up. The emergency fund was already drained. The credit lines were already stretched. The owner already tried to keep payroll alive. The family already made the hard choices. Bankruptcy is simply the moment the system stops pretending everything can still be fixed with another payment plan. And that is why this matters far beyond the courthouse. When bankruptcies rise, lenders tighten. Credit becomes harder to get. Businesses pull back. Hiring slows. Consumers spend less. One failure becomes another person's lost income. That is how financial stress stops being personal. It becomes structural. And once households and businesses begin breaking under debt, the next question becomes unavoidable. What happens when the biggest borrower in the country is doing the exact same thing, only on a scale so massive it almost stops sounding real? In fiscal year 2025, the federal government spent about $7.01 trillion while collecting roughly $5.23 trillion, leaving a deficit of about $1.78 trillion. That means Washington spent nearly $1.8 trillion more than it brought in a single year. Not during a depression, not during a complete economic shutdown, during a period when officials still insisted the economy was strong. That is what makes this so dangerous. The government is not acting like a country preparing for impact. It is acting like consequences have been permanently canceled. Every shortfall becomes another treasury auction. Every crisis becomes another spending bill. Every uncomfortable choice gets pushed into the future and renamed financing. But the future is not some imaginary place where debt disappears. It arrives as interest. Net interest payments on the national debt reached about $1 trillion in fiscal year 2025, making interest one of the largest federal expenses, bigger than many core functions of government. That is money not building roads, not lowering healthcare costs, not strengthening families, not repairing the productive economy. It is the price of carrying yesterday's promises into tomorrow. And this is where the anger becomes justified. Ordinary people are punished immediately for falling behind. Late fees hit, credit scores drop, bankruptcy follows. But Washington can miss reality by $1.8 trillion and call it policy. That imbalance is not just financial, it is moral. Because when government debt keeps rising, the pressure does not stay in Washington. It moves into bond markets, mortgage rates, taxes, inflation risk, and the cost of borrowing across the entire economy. The federal government can delay pain longer than a household can, but it cannot prevent the bill from moving downstream. And that is the bridge to the next danger. While the public sector is borrowing like the limit does not exist, Wall Street is still pretending asset prices can rise forever. While Washington keeps borrowing like the future is someone else's problem, Wall Street keeps floating on a different kind of illusion. The belief that money will keep arriving automatically no matter what is happening underneath. This is the quiet machine behind the modern market. Every paycheck, millions of workers send money into retirement plans. Every month, index funds and ETFs buy the same basket of stocks. Not because every company is strong, not because every balance sheet deserves confidence, but because the rules of the fund say, buy. The money enters the system, spreads across the index, and pushes the biggest names even higher. That is why the stock market can look powerful while the real economy feels exhausted. By the end of 2024, index mutual funds and index ETFs held about 51% of all long-term mutual fund and ETF assets, up from only 19% in 2010. By February 2026, index mutual funds and ETFs had grown to about $20.06 trillion in combined assets, even larger than active mutual funds and ETFs at about $18.01 trillion. That shift changed the character of the market. More money now moves according to flows, formulas, and allocation rules. Less money asks a brutal question: is this stock actually worth the price? And the danger is concentration. When automatic money floods into broad indexes, it does not spread equally in spirit. It rewards size. The largest companies receive the largest share because they already dominate the index. A handful of mega-cap stocks can begin carrying the emotional weight of the entire market. The chart rises, people relax, retirement accounts look healthy, but underneath, the same crowded trade keeps getting bigger. This is not investing anymore in the old sense. It is a conveyor belt, and conveyor belts are comforting only while they move in one direction. When inflows slow, fear rises, or investors need cash, that automatic machine can stop feeling like stability and start behaving like pressure. Because if blind money helped lift everything together, then panic can also pull everything down together. And if the stock market has been lifted for decades by automatic money, the most dangerous question is simple. What happens when the people feeding that machine stop feeding it and start pulling money out? This is not theory anymore. The American retirement system has become enormous. Total U.S. retirement assets reached about $49.1 trillion at the end of 2025, with roughly $10.1 trillion sitting in 401k plans and about $19.2 trillion in IRAs. That is not a side pocket of the economy. That is one of the biggest pools of financial fuel on Earth. For decades, the direction was mostly one way. Workers contributed, employers matched, funds bought stocks, indexes absorbed the money, asset prices climbed. The entire system quietly depended on millions of people being in the saving stage of life. But America is aging out of that stage. Around 10,000 baby boomers have been turning 65 every day on average across the long retirement wave from 2011 to 2029. And once retirees move deeper into retirement, the logic changes. They are no longer trying to build the pile. They are trying to live from it. That shift becomes even more serious because required minimum distributions force withdrawals from many retirement accounts. Under current IRS rules, people generally must begin taking required minimum distributions from traditional IRAs and many retirement plans at age 73. So the same retirement accounts that once acted like a steady buyer can slowly become a steady seller. And this is where the machine gets fragile. If markets are high, retirees sell assets to fund living costs. If markets fall, they may still need to sell because food, housing, insurance, and medical bills do not wait for a recovery. That turns retirement from a personal milestone into a market pressure point. This does not mean every retiree dumps stocks at once. The danger is more subtle than that. It is a demographic tide. Fewer peak savers pushing money in, more retirees drawing money out, more portfolios shifting from growth to safety. And when automatic inflows weaken at the same time valuations are stretched, the market loses something it rarely admits. It depends on constant demand. If retirement money is the slow river that helped lift the market for decades, corporate buybacks have been the emergency pump running beside it. Quieter, faster, and brutally effective. For years, companies did not just sell products, earn profits, and reinvest. They bought back their own shares. That matters because when a company reduces the number of shares available, earnings per share can look stronger even if the real business is not growing at the same speed. It is financial engineering dressed up as confidence. And Wall Street loved it because buybacks created steady demand, supported stock prices, and made the market look healthier than the economy beneath it. But now that support beam is starting to look less reliable. S&P 500 companies spent a record $293.5 billion on buybacks in the first quarter of 2025. But that dropped to $234.6 billion in the second quarter, a 20.1% decline, before recovering to $249.0 billion in the third quarter. Even with that rebound, third quarter buybacks were still about 15.1% below the first quarter record. That is the warning. The money did not disappear because corporations suddenly became humble. It is being pulled towards something even more expensive: AI infrastructure, data centers, chips, power contracts, and debt-funded expansion. Goldman Sachs reported that AI-driven capital spending jumped while buyback growth stalled, showing how the market's biggest companies are being forced to choose between supporting their stock today and funding the artificial intelligence race tomorrow. And the concentration makes it more dangerous. Buyback activity has become increasingly top-heavy, with the largest companies dominating the dollar amount of repurchases while fewer firms announce new plans. So the market is not losing one support. It is risking two at once: older investors pulling money out and corporations redirecting cash away from share support. That is how a market can look strong right before it becomes fragile. The pillars do not vanish overnight. They weaken slowly, quietly, quarter by quarter, until one shock hits and everyone suddenly realizes how much of the strength was manufactured. And that shock may not come from Wall Street at all. It may come from something every household already understands: prices rising while jobs weaken. And when the market support beams start weakening, the final blow does not have to come from a trading floor. It can come from the gas pump, the grocery aisle, the freight bill, and the paycheck that no longer stretches far enough. That is what makes stagflation so terrifying. Inflation alone is painful. A weak job market alone is painful. But when prices rise while labor power softens, people get trapped from both sides. They pay more to live while having less confidence that income will keep up. That is not a slowdown. That is an economic vice. The warning signs are already flashing. In March 2026, the Consumer Price Index was up 3.3% from a year earlier, while energy prices jumped 12.5%. Gasoline alone surged 21.2% in March, the largest monthly increase in the series going back to 1967. Food was still up 2.7% year over year, and electricity rose 4.6% over the same period. At the same time, the labor market no longer feels bulletproof. The unemployment rate stood at 4.3% in March, with about 7.2 million people unemployed. Payroll still grew by 178,000, but that headline does not erase the pressure households feel when hours get cut. Hiring slows, bonuses vanish, and workers realize replacement jobs may not pay enough to cover the new cost of living. And oil is the accelerant. Brent crude was around $106 per barrel on April 24, 2026, roughly $39 higher than a year earlier. When oil rises, it does not stay inside energy markets. It moves through trucking, airlines, plastics, fertilizer, packaging, medicine, construction, and food distribution. Diesel is not just fuel. It is the blood pressure of the supply chain. That is why this trap is so brutal. The Federal Reserve cannot easily cut rates to rescue jobs if energy shocks keep inflation alive. But it also cannot keep money tight forever without crushing housing, credit, small businesses, and hiring. So ordinary people get stuck in the middle. Higher prices, weaker security, more expensive debt, less room to breathe. And once stagflation starts squeezing households, companies, and credit markets at the same time, the pressure does not stop at the front door of the bank. It travels straight into the balance sheets most people never see. This is the part of the crisis that rarely announces itself with sirens. Banks can look calm from the outside while the machinery underneath is already overheating. The lobby stays open. The app still works. The debit card still swipes. But behind the curtain, higher interest rates, weaker borrowers, falling bond values, and commercial real estate stress can quietly turn stable institutions into fragile ones. At the end of 2025, the FDIC's problem bank list increased to 60 banks, up from 57 in the prior quarter. That was still only 1.4% of all banks, but the direction matters because stress does not need every bank to fail. It only needs confidence to break in the wrong places. The same FDIC report showed the industry still carried unrealized securities losses, meaning many banks owned bonds worth less on paper than what they paid for them. Those losses may stay hidden if banks can hold the assets to maturity, but if deposits flee or cash is needed fast, paper losses can become real pressure. And the risk is no longer just inside traditional banks. The shadow system has grown massive: private credit, non-bank lenders, business development companies, and funds that lend money outside the cleaner, more regulated banking channels. The Federal Reserve warned in its November 2025 financial stability report that private credit was being cited more often as a concern, partly because its opacity makes it harder to know where stress could spread if borrowers weaken or a non-bank institution fails. That is the terrifying word: opacity. Nobody fully sees the pipes until one bursts. The IMF also warned in April 2026 that private credit liquidity mismatches may look contained, but rising borrower defaults could still cascade into broader corporate credit stress. So the danger is not only a bank run, it is a confidence run. Investors pulling back, lenders tightening, funds locking redemptions, businesses losing credit, and banks becoming more defensive all at once. And when the hidden banking system starts protecting itself, the danger moves beyond balance sheets. Credit tightens, loans become harder, businesses delay expansion, households lose breathing room, markets stop trusting each other. That is when a financial problem becomes something much larger, not just a crisis in money, but a crisis in daily life. A normal financial crisis usually begins in one place: a housing bubble, a banking panic, a market crash, a credit freeze. But this moment is more frightening because the pressure is not concentrated, it is everywhere at once. The federal government ran a $1.78 trillion deficit in fiscal year 2025, spending about $7.01 trillion while collecting only $5.23 trillion. That means the public sector is borrowing aggressively while households are already stretched and businesses are already cautious. At the same time, inflation is not dead. In March 2026, the Consumer Price Index was up 3.3% from a year earlier, energy was up 12.5%, and gasoline jumped 21.2% in a single month, the biggest monthly gasoline increase since the series began in 1967. That does not stay inside a gas tank. It moves through freight, food, utilities, production, and every business that depends on transportation. Then add the retirement machine. U.S. retirement assets reached $49.1 trillion at the end of 2025, equal to about 34% of all household financial assets. If even a small shift happens from accumulation to withdrawals, the market loses one of its quietest sources of constant support. And behind all of this, the banking system is not perfectly calm. The FDIC's problem bank list rose to 60 banks in the fourth quarter of 2025, while unrealized losses still remained inside the system. That does not mean every bank is collapsing. It means stress is already present before the bigger shock arrives. This is why the fear feels different, because this is not one broken pipe. It is the whole building losing pressure. Consumers are weaker. Government borrowing is heavier. Energy is volatile. Markets are crowded. Retirement flows are shifting. Banks are cautious. Credit is fragile. And trust, the invisible foundation underneath everything, is thinning. A financial crisis destroys portfolios. This could destroy confidence. And once confidence breaks, no bailout can instantly rebuild it. The most terrifying part is not that people sense something is coming. It is that they may already be living inside the first stage of it. The collapse may not arrive with a single crash. It may arrive as a country slowly realizing the safety net was already gone.